So it's another perfect evening we have met for this advanced financial reporting and analysis session. So I'm going to look at consolidated cash flow statements, of which specific area I will be doing the receipt in question. So I will be displaying the past paper for that relevant city. We go through the question, then I do the presentation on my whiteboard. So this is the relevant question. I've shared the link to this past paper under the chat. You can be able to access it. So it's advanced financial reporting and analysis, question number 4, December sitting. So December 2024 sitting. So the question reads, the following are consolidated financial statements of Ndofu Group for the year ended 30th September 2020. That is 30th September 2024, 2023. So you have a consolidated statement of financial position. Consolidated statement of financial position. You know, statement of financial position contains assets, equity, and liabilities. We don't have to go through each item. You know what the statement of financial position contains. Then we move to the consolidated statement of profit or loss and other comprehensive incomes for the year ended 30th September 2024. So you know also what statement of profit or loss contains. So from revenue up to other comprehensive incomes items. Additional information number 1, depreciations of 2,400 million was charged during the year ended 30th September 2024. Plant with a carrying amount of shillings 1,560 million was sold for 1,720 million. The gain on disposal was recognized in operating cost. Property was revalued during the year, resulting in a revaluation gain of 1,400 million being recognized. Number 2, during the year ended 30th September 2024, Ndofu Limited acquired 75% of the ordinary share capital of Simba Limited, paying cash consideration of 9,400. The non-controlling interest was measured at its fair value of shillings 2,125 million at the date of acquisition. So the fair value of Simba Limited is net assets at acquisition was made up as follows. So we have the property, plant and equipment, inventory, accounts receivables, cash and cash equivalents, accounts payable, current tax. So number 3, during the year ended 30th September 2024, Ndofu Limited also disposed of its entire 80% ordinary shareholding in Kifaru for cash proceeds of 5,300, not 3,000. So there was Kifaru which was sold for a cash proceeds of 5,300. This subsidiary was not considered as separate unit of operation. Kifaru Limited had been acquired several years ago for cash consideration of 3,750 Kindly maintain silence so that I cannot be able to mute everybody permanently. So if that can be forced, if you can force me to go that route, I will do it. So kindly mute your mic. Do that. That is what I will request. So I was reading number 3, whereby there is an 80% a company called Kifaru, which was disposed at 5,300. This subsidiary was not considered as a separate unit of operations. Kifaru Limited had been acquired several years ago for cash consideration of 3,750. You cannot dispose something you don't own. Remember, it was acquired some times back. That is why you are told that it was acquired several years ago at 3,750, of which when they disposed it, they disposed at 5,300. Remember, it was an 80% shareholding subsidiary. The non-controlling interest of 20% was measured at its fair value of 2,000 million as at acquisition. And the fair value of Kifaru Limited net assets were 4,600 million as at that date. Goodwill had not suffered any impairment. Goodwill had not suffered any impairment. So you are given the net assets of that Kifaru. As at the date of disposal, the net assets of Kifaru were carried in consolidated statement of financial position as follows. You have the relevant net assets of Kifaru: property, plant and equipment, inventory, receivables, cash and cash equivalents, accounts payable. So required, they need us to do a consolidated statement of cash flows for Ndov Group for the year ended 30th September 2024 using indirect method in accordance with I7, statement of cash flow. Statement of cash flow. That is what the examiner needs us to do. Do what? Go ahead and present a consolidated. Go ahead and present a consolidated cash flow statement using which method? Using the indirect method. Using the indirect method. Using the indirect method. So this is what you are supposed to do. I will present this in the next around 40 minutes. The presentation of that cash flow statement for the next around 40 minutes. 40 minutes or around 50 minutes. So we'll come here and say Ndov Limited, consolidated what? Consolidated cash flow statement. Consolidated cash flow statement. So that is for the year. For the year ended. So our financial was ending on 30th September 2024. 30th September 2024. So I would have two columns. So shillings. It was in terms of millions. Million. And the shillings here in millions. So when we talk about indirect method, so there's a format you're supposed to follow, and that is the one I will be following here. So I will start from operating activities. Operating activities. So for operating activities, you start from the profit before tax. So go back to your statement of profit or loss. Under the statement of profit or loss, under that question, remember I've shared the question under the chart. There's a link. You can use it to access the past paper. So under that statement of profit or loss, the profit before tax was 66 what? 66.90. So this profit before tax must be adjusted. You adjust it. So you come and say adjusted for. Adjusted for. So now, remember that in getting my profit before tax, this is under the income statement which we have. This is under the income statement which we have. So the profit before tax. So we have an income statement. We have an income statement where we have started from revenue going down. We have started from revenue, less cost of sales. We have deducted the cost of sales. We have gross profit. We have added some incomes. We have added some incomes. Then we have deducted what? Less expenses. We have deducted some expenses. So we have some expenses which are operating and non-operating. So we have expenses which are operating and some which are non-operating expenses. So the non-operating expenses and some of the non-operating incomes, those are the ones we adjust against the profit before tax. So the non-operating expenses. So I was saying that when talking about indirect method, we start from the profit before tax. Then that profit before tax, we adjust it. So we adjust this profit before tax against the non-operating incomes and expenses. So some of these non-operating incomes and expenses are depreciation. You just write even before you check if they are present. You talk about depreciation. You talk about impairment. You talk about impairment. You talk about amortization. You talk about amortization. You talk about loss on disposal. You talk about loss on disposal. Then you can talk about gain on disposal. You can talk about gain on disposal. So these are some of the 5 non-operating, or we call them non-cash flow. We can call them non-operating or non-cash flow incomes. Non-cash flow incomes and expenses, which are adjusted against the profit before tax. Even if there's others, these are the ones you start with. You start with these, 1, 2, 3, 4, 5. So once you just write them down, go to the question and check if they are present. Go to the question and check if they are present. So if you can go to your question, if you go back to your question, you can be able to see under additional information number 1, you are told that the depreciation was, so depreciation of 2,400 was charged during the year ended 30th September 2024. We have the depreciation of 2,400. We have the depreciation of 2,400. 2,400. We have the 2,400. So remember that this one, it was deducted for you to get the profit before tax. So what you do, you add back. So you check impairment, you check for impairment. But remember to check for impairment. What's impairment? How does impairment arise? Impairment arises from goodwill. Goodwill is what? Goodwill is impaired. Goodwill is impaired. So we have to do analysis of goodwill. We have to carry out a goodwill analysis for us to determine if there's what? This aspect of impairment. So here, I will come and say, this is our key analysis of a goodwill. The analysis of goodwill. Of which you know that goodwill is what? How do you determine goodwill? From your FR. Goodwill is equal to purchase consideration. Goodwill is all about purchase consideration minus what? Net assets. Net assets, asset acquisition. Net assets, asset acquisition. Purchase consideration minus net assets, asset acquisition. The net assets, asset acquisition. So, what you need to know, remember that in our statement of financial position, we have the statement of financial position for 2024 and 2023. But you need to check your dates well. You need to check your dates well. You need to check your dates well because the financial year is ending on 30th September 2024, 30th September 2023. So we have 30th September 2024, 30th September 2023. So remember that the balances closing 2023 will be opening balances for 2024. Because if I draw a number in here, if we have a previous year ending on, we have 30th September 2023, and we have here 30th September 2024. 30th September 2024. So these balances of 30th September 2023 will be the one opening 1st October 2020 what? 2023. 1st October 2023. Meaning that the balances from 30th September 2023, the balances carry down. Balances carry down. So the balances carried down will be my balances here brought forward. So the balances closing this previous year are opening balances here. And you have the balances for the end of 30th September 2024. So when I'm doing my analysis for goodwill, I will just say balance. So the balance brought forward, and say brought forward, balance brought forward from 2023. So if you check your question, goodwill is, if you check your statement of financial position, if you check your statement of financial position as of 2023, the goodwill is 11, 5 what? 560. 11, 560. So never forget that there was acquisitions and what? Acquisitions and the disposal of subsidiaries. You have to incorporate them. They have to be incorporated when doing the presentation or when doing the analysis. So you need to determine the goodwill of those two subsidiaries. So you have to determine the goodwill of those two subsidiaries. So you have to determine the goodwill of other question number 4, additional information number. This additional information number 2. There was this Simba, which was acquired during the year 30th September 2024. Ndofu acquired 75% of the ordinary share capital of Simba. So you need to determine the goodwill of Simba, and you need to determine the goodwill of what? Kifaru. Under additional information number 3, there is Kifaru. There is this Kifaru. So Simba was acquired. So add goodwill on what? On acquisition of what? On acquisition of Simba. The goodwill on acquisition of Simba. So I have said that goodwill is purchase consideration minus net assets, asset acquisition. But when doing your goodwill, you can either use full method or go for the partial method. You can either use the full method or use the partial method. So, under additional information number 2, when this company called Simba was acquired, they paid 9,000 what? 9,400. 9,400. That is the purchase consideration. Plus the fair value of the non-controlling interest. Because when doing your goodwill, you can use full method or a partial method. You can use full or a partial. On this scenario, we are using full method because the NCI, the non-controlling interest, is measured at its fair value. So that 2125 must be added back here. Then you raise the net asset. So it's all about purchase consideration and fair value of the non-controlling interest as at acquisition less the net assets. So the net assets are given the block value in note 2, which is 93 what? 93.15. So under the chart, what are you getting? So if you take 9400 plus 2125 minus 93.15, give me the answer. Give me the answer. If I use my calculator, 9400 plus 2125 minus 93.15. I'm getting 2210. I'm getting 2210. I'm getting 2210. Remember, this is on the goodwill on acquisition of Simba. Then you raise the one for disposal. Goodwill on disposal of Kifaru. On disposal of Kifaru. So when Kifaru was disposed, so we need to check the time it was acquired, the goodwill as at the time it was acquired, that is. So the purchase consideration was, that is according to note 3. When it was acquired several years ago, it was acquired at 37.50 plus the fair value of the NCI. NCI is measured at fair value, of which we have 2,000. The fair value of the non-controlling interest. We deduct the net assets as at acquisition. As at acquisition, not as at disposal, as at acquisition. Goodwill is computed as at acquisition. Goodwill is computed as at acquisition. So it's all about 37.50 plus the fair value of the non-controlling interest minus the 4,600. So you are getting 11. So this is deducted. So up to this point, the analysis we have is 11,560 plus 2210 minus 1150. So that is 12,620. That is 12,620. 620. That is 12,620. So now, what about the goodwill as at the end? Balance. So the goodwill balance correct forward. So skip one line and say balance correct forward. So the balance carried forward for the goodwill as at the end of 2024 from the question. So the goodwill is 12,060. So you can see there's a reduction from 12 after analyzing, after taking the balance brought forward plus goodwill as at the acquisition of Simba minus as at the disposal of Kifaru, we have 12,620, but at the end we have 12,060. So there's a reduction. There's a reduction by which value? We have a reduction by 560. So this reduction is what we call impairment. It's what we call impairment. That is another expense which we need to do what? To add back. So was there amortization? No. Because if you check under the non-current assets, we don't have any other intangible assets we can analyze so that we determine the amortizations. Other intangible assets are amortized other than goodwill, which is done what? Which is impaired. So far we are done with these three items. So we check if there's any loss on disposal. If there's anything they disposed and they got a loss. Is anything they disposed and they got a loss? Under note 1, because you have the question, I have the soft copy of the same kind. Under additional information number 1, they said plant with a carrying amount of 1,560 was sold for 1,720. So there's a gain on disposal, which was recognized in the operating costs. That is why we adjust it against the profit before tax, because it was already affecting the operating. It was already affecting the operating cost. So then there was a property which was revalued. No, revaluation doesn't affect the operating. Doesn't affect the operating activities. So for now, we have a gain. So we have a gain. We have a gain on disposal of plant. So that gain is, so 1,720 minus 1,560. So that is 100 and what? That is 160. So that is 100 and what? 160. So that is 160. So remember that the gain was an addition. So we do what? We deduct. So I think so far I'm done with the additional information. I'm done with additional information in terms of checking these 5 items. So I go back to my income statement. That is statement of profit or loss. So if you can go to you go back to the statement of profit or loss. So if you go back to your statement of profit or loss, under the profit before tax, go backwards. Go backwards that way. So under that statement of profit or loss, you can see there's revenue. There's cost of sales. So anyway, I don't have to write everything. I can mention there's revenue, there's cost of sales, there's operating expenses, there's profit from operations, there's gain on disposal of a subsidiary, then finance cost, share of profit of associates, then we have profit before tax. Then they got this. So what am I supposed to adjust again? And that's profit before tax. So other than this aspect of revenue, cost of sales, other than revenue, cost of sales, operating, we talk about the operating expenses. Other than these items, operating expenses can be admin expenses, or can be a distribution cost. So the operating expenses. So other than revenue, cost of sales, and the operating expenses, or which operating expenses is the admin expenses and the selling and distribution expenses. So other than the four items, that is revenue, cost of sales, admin, expenses, and distribution. So other than the revenue, cost of sales, admin expenses, and we have what we call a distribution cost, other than those four. Any other item which is above this profit before tax, adjust it here. So if you look at your statement of profit and loss, so other than the four, we have, I will start with other than the four, we have share of profit or share of profit of associate. That is the first item. So that share of profit of the associate is 220. So that one you add, it was deducted. We talk about the finance cost. So the finance cost is all about so the share, this one was not 220 but 720. So this is 720. So the share of profit of associate is 720. It was added, you subtract. Then we have finance cost of 220. It was deducted, you add. Then we have the gain on disposal of subsidiary. Gain on disposal. So there was this so remember, there was no loss, there was only gain. So there was one gain, then there's another gain, and there's another gain under the statement of profit or loss. So there's that gain on disposal. Gain on disposal of subsidiary. So we have the gain on disposal of subsidiary. So gain on disposal of subsidiary is 350. Then you deduct. So far we are done with the adjustments which we were supposed to pick. So up to that point, we'll be able to talk about cash flow before changes in working capital. Before changes in working capital. Which is the value for this cash flow before changes in working capital? So guys, what do you have? From my calculator, I have 8640. So the cash flow before changes in working capital. Then we go to changes in working capital. Changes in working capital. So I can see the students having questions. I can address them before we continue. How much for the video classes, please? Video classes. So for the new students who have joined this session today, remember that we do online classes. So these classes are done on Mondays, 8 p.m. Monday and Tuesdays. Mondays and Tuesdays, 8 p.m. The number has been shared under the chat if you want to join. So for my contact is 0728 760 546. Or there's that another one which has been shared under the chat, which is 0745. Or you can use 0745 58 72 96. So those are the numbers you can use if you want to join the ongoing online classes. I do online classes Mondays and Tuesdays. I do online classes on Mondays and Tuesdays, 8 p.m. to 10 p.m. And on some cases on Sunday, 8 p.m. to 10 p.m. So the amount I charge for the online classes is 5,500. 5,500. That is what I charge for the online classes if you want to join. 5,500. So you will be able to get the online classes, including the videos. So the way we do online classes here, the way I'm doing them now, so you can be able to hear them. So plus what? Plus the videos, plus the videos, plus the videos. So if you want to reach out to me direct, so you can use either of the number. You can use either of the number. It has been written on the whiteboard here. So we continue. So changes in working capital. So for changes in working capital, we can do our working here. The changes in working capital. So there's a working which can be done. So we look at for this question, or in most of the questions, we look at 3 items. We look at current assets and current liabilities. So under current assets, we look at inventory, increase or decrease. We look at inventory. We look at receivables. We look at receivables. We look at receivables, and we look at payables. Under current liabilities, we look at payables. So we are looking at increase or decrease of these. So increase or decrease of the inventories, receivables, and payables. So the increase or decrease. So we start with balances brought forward. So the balance brought forward. So the balances brought forward, these are balances from the end of the previous year, 30th September 2023. So the inventory was 2780. And what about receivables? Receivables is 2060. Then payables is, so the payables is 4530. 4530. Never forget there was a subsidiary which was disposed and another one acquired. So you add the one acquisition. For acquisition, you add. For acquisition, you add. Talk about acquisition of new subsidiary. Add acquisition of new subsidiary. Acquisition of new subsidiary. So the acquisition acquisition of new subsidiary. So when the subsidiary was acquired, under additional information number 2, the inventory was 940. The inventory was 940. The receivables was 1,500, and the payables was 1375. And you raise for disposal. Remember that Q4 was disposed. Simba was acquired. So acquisition you add, disposal you do what? You deduct. Disposal, you deduct. So you come and say raise, dispose of subsidiary. Dispose of subsidiary. So the dispose of subsidiary. So the inventory is 1030. What about so this one you deduct? What about the receivables? Receivables we have is 750. Then for the payables is 510. So get the balances so far. Get the balances so that we compare with the balances carried forward. So that we check if there's an increase or a decrease. If there's an increase or a decrease. So 2780 plus 940 and minus 1030. So this is 2690. The second one is 2060 plus 1500 minus 750. 2810. 2810. Then the last one is 4530 plus 1375 minus 510. So this is 5395. So skip one line there. Say balance carried forward. So now compare these balances with your balances carried forward. Those are the balances as of started September 2024. So the balances from your statement of financial position as of 30th September 2024. Inventory is 2970. Receivables is 2440. Then for payables is 4375. 4375. 4375. So there's an increase. Here we have an increase. Here we have an increase. I can use this one. So it's increase or decrease. Increase, stroke decrease. So 2690 minus 2970. So we have a decrease. We have an increase of 280. So this is an increase. Then this is a decrease, and this is a decrease. So 2810 minus 24 for 2440. So this is 370. That is 300 what? 370. Then 5395 minus 4375. So this is 1020. It's a decrease. So we have increase in inventories. Increase in inventory. What does it mean when your assets increases? It means that there's cash out. So this one you deduct. So from the point of changes in working capital going up to the financing activities, now we will be looking at, for you to know that it's a deduction or an addition, you look at, are you doing analysis whereby there's a cash inflow or a cash outflow? So that you know you are supposed to deduct or add. Like now when inventory increases, it means that you have bought stock. You have bought stock, so there's cash out. Increase in what? Increase in debtors. Increase in receivables. Your debtors have increased. You have given them money, so that is money out. Your debtors have increased. You have given them money, they have increased. Your creditors have decreased. This is a decrease, not an increase. Sorry. So your debtors have done what? Your debtors have decreased. Your debtors have decreased. It means that they have paid you. They have paid you. They have paid you. So when your debtors decreases, it means that they have done what? They have paid you money. So they have paid you money. That is an addition. That is an addition. That is an addition. Then we go to liabilities. We go to liabilities. So this is creditors. Your creditors have decreased. Your liabilities have decreased. Your liabilities have decreased. So what does it mean? Who are the creditors? Creditors are the people who buys from you. Or who are the creditors? The people you do what? You buy from them on a credit basis. Most of the businesses operate on a credit basis. You don't have to pay on cash. It's not everything which is paid on cash. Sometimes you receive products, you pay later. So the people who sells to you on credit, those are creditors. We maintain an account called the trade payables account for them. So now they have decreased, meaning that you have paid them. You have paid them. You have paid them. Decrease in payables. Decrease in payables. So that is 1020. So you have paid them. So that is a cash out. So that is a cash out. So up to that point, we can say that cash generated from operations is cash generated from operations. So the cash generated from operations. So we take 8640 minus 280 plus 370 minus 1020. So this is 7710. This is 77 what? 7710. We continue. We are almost done with operating activities. Then we move to other small areas like investing and financing. The only wide part was these operating activities. So we continue. So once we have cash generated from operations, we have two items to consider before we close the cash outflow or cash inflows from the operating activities. So we need to check the interest paid. So the finance cost. So the finance cost, this one which is considered here, it must reduce this 7710. So we deduct that. Then also deduct tax paid. So for the tax paid, for you to do analysis of tax, you consider the deferred tax and current tax. Deferred tax. Consider your deferred tax and current tax. You analyze on this basis. So the deferred tax and also the current tax. So the balance brought forward. So for the guys joining, for the new students joining, I can share this question again under the chart. It's a form of a link. It's AFR question, Advanced Financial Report. December 2024, question number 4. Question number 4, AFR, that is Advanced Financial Reporting and Analysis, December 2024. Question number 4. So, and I've said that whoever could like to join the ongoing online classes on Mondays and Tuesdays, 8 p.m. to 10 p.m., you can contact me through either of the two numbers. So we have the first one. This is my personal number, and there's this one. The 0728 765 46. And there's the second one. So the balance brought forward. So for the deferred tax, so the balance brought forward. Remember, it's balances from 30th September 2023. So under non-current liabilities, the deferred tax is 650 plus the current tax. Under current liabilities, we have the current tax. We have the current tax as 2485. These are the balances brought forward. Deferred tax, current tax. So you sum them. You get, I'm getting 31, 35. So go to the additional information and acquisition of what? Of new subsidiary. So when that new subsidiary was acquired, if you can look at under the net assets, is there any current tax or deferred tax? Under note 2. We have the current tax of 250. Then for the Kifaru, we don't have any. You need to add the income tax for the year from the income statement, that is from the statement of profit or loss. Add income tax for the year. From the statement of profit and loss, income tax for the year. So the income tax for the year is from the statement of profit or loss, 1,400. 1,400. So that 135 plus 250 plus 1,400 is 4785. Skip one line, say balance carried forward. So deferred tax, balance carried forward under current liabilities, under the non-current liabilities, under the non-current liabilities. So the deferred tax, 940. That is as of 30 September 2024 plus the current tax, 30 September 2024, 2530. 2530. So 940 plus 2530. That is 34. 3470. So there's a decrease. So that is the analysis we do. Here we don't have to compute the current tax is equals this and this. No, here we do analysis. What we do under cash flow is just analysis. So 4785 minus 3470 is 1315. So that is what they paid, tax paid. So that is the one you deduct here, 1315. 1315. So that you have the net cash flow. Net cash flow generated from what? Generated from operations. So the net cash flow generated from operations is 7710 minus 220 minus 1315. So that is 6175. So that is A. That is my A. And now we can do B and C. Investing activities. Investing activities. Any question before I continue with investing activities? As I also take a glass of water before we continue. Any question? It's your time to ask. So when we are talking about investing activities, the investing, we just look at around 5 items, not much, around 5. We look at around 5 items. So we look at if they disposed an asset, what they received, or if they sold an asset, any non-current asset, what they did what. So if they disposed, they received. If they acquired, they paid. So here under investing, we are looking at the change in size and compositions of the non-current what? Non-current assets. So the first thing you do under investing, do analysis of PPE. Analysis of property, plant, and equipment. Property, plant, and equipment. So this one, we are checking if there is any acquisition or what? Any disposal. Any acquisition or any disposal which occurred. So the balance brought forward for the property, plant, and equipment. Balance brought forward. The balance brought forward from the question, it's just direct. From the statement, it's 10,150. So that is the balance. 10,150. As of 30 September 2023. After you have taken your balance put forward, go to the additional information. Check that from additional information number 1 to last, what can affect property, plant, and equipment. Remember, property, plant, and equipment, this is all about tangible assets which have been aggregated. The aggregation of tangible assets. So check from additional information number 1 to the last, which item do you have which is affecting a tangible asset? From note 1, we have depreciation. We have depreciation. Depreciation was 2,400. That one reduces this. That one reduces those values. Sorry for the interruption. So the first item I can see is depreciation. Then the next one is, after depreciation, under note 2, there was a plant which was disposed. And since we have started with a balance brought forward, which is a carrying amount, and in addition, information number 1, there's a plant which was disposed. So we need to consider the carrying amount of disposal plant, its carrying amount. So we consider the carrying amount, 1560. So depreciation, disposal. Then there was revaluation of property. Property was revalued. Revaluation of property. Property was revalued. Revaluation is an increase in value by 1,400. That one you add. Additional information number 2. On acquisition of new subsidiary. Acquisition of new subsidiary, we have a plant stated at 8,000. We have a plant stated at 8,000. What about on disposal of subsidiary? On disposal of subsidiary, we have a property, plant, and equipment stated at 4530. Stated at 4530. Nothing else. So if we do that, we have 10,150 minus 2,400 minus 1,560 plus 1,400 plus 8,000 minus 4530. So that is 11,060. 11,060. So consider your balance carried down or carried forward. So from the question, from the statement of profit or loss, that is as at 30th September 2024. That is 15,900. So you can see there is an increase. There is an increase from 11,060 to 15,900. So that is not a disposal, but a purchase. That is a purchase of a property, plant, and equipment. The balancing figure is an acquisition because there is an increase. It's not a reduction. There's an increase from 11,060 to 15,900. So 15,900 minus 11,060. So that is 48,40. So that is 48,40. So you will say cash received. So purchase. So that is cash paid. Cash paid on purchase. On purchase of PPE, property, plant, and equipment. So that is 48,40. That is 48,40. It is okay. So looking at the same additional information, after doing the analysis, I think you have understood this. So this is the first thing you do: analyze your property, plant, and equipment to check if this disposal or acquisition. This is a purchase. So this is a purchase. So then we go back to the additional information. Remember additional information number 1. There was that plant which was done what? Which was sold. Of which it was sold, yes. Its carrying amount was 1560. But it was sold at 17 what? 1720. They received this 1720. So you will say disposal of plant. Disposal. So cash received. Cash received on disposal of plant. On disposal of plant. Then after that, note 2. Remember, a subsidiary is an asset. It was done what? It was acquired. It was acquired. When they acquired this, they paid 9,400. So you come here and say net cash paid. Net cash paid. Net cash paid. So you have to go with the net cash paid to acquire subsidiary. To acquire subsidiary. The net. Yeah, but yes, it was acquired at 9,400. It was acquired. So they paid this 9,400. But when they acquired it, it came with some cash. Under the net assets, there's some cash it came with. There's some cash. So that must be deducted. Because even if we paid 9,400, when we were acquiring this Kifaru, under the net assets, we have cash and cash equivalent of 500. That one must reduce what we paid. So that one is 8,900. So we paid 8,900. Yes, we paid 94, but it came with 500. So that one must be deducted. Then remember, we disposed Simba. We disposed the Simba. So Simba was the one which was acquired. We disposed Kifaru. That is under note 3. So note 3 disposed 80% of the ordinary, that is ordinary shareholding in Kifaru for cash proceeds of 5,300. 5,300. 5,300. So also you will say net cash proceeds. Net cash proceeds. Net cash proceeds. So the net cash proceeds from disposal of subsidiary. From disposal. From disposal of subsidiary. From disposal of subsidiary. So we have 5,300. When they disposed this, they received 5,300. But when they received this 5,300, when they were disposing this Kifaru, it went with some money. Under its net assets, we have some cash and a cash equivalent of 300. We must deduct. Yes, we have received this amount when disposing. But when disposing, there's some cash under net assets. There's some cash under net assets which went out. So we must net that. That's why I'm using the word net. Cash proceeds from disposal. Net cash paid. Net cash paid. Not just cash. Net cash paid. So, last but not least, for investing, before we finish with financing. So we have looked at purchase of assets, right now property, plant, and equipment, cash received on disposal of plant. We have talked about cash paid to acquire subsidiary and the net cash proceeds from disposal of subsidiary. So, but if you look at your statement of profit or loss, they did an investment and associate. There's an associate where the parent invested. Even if you look at your non-current assets, there's investment in associate. So under that investment in associate, we need to check for dividends received. So obviously, when analyzing that, what we are checking for, when we are analyzing the investment in associate, what we are checking for is the dividend received from that associate. Dividend received from associate. So what you do, you pick the balance brought forward. Investment in associate. These are the balances under non-current assets. So the balance brought forward is 3375. So they invested this as at the start of the year, which is the balance from 30th September 2023 plus what the parent received during the year. If you look at your statement of profit or loss, there is this share of profit of associates, 720. So that is an income during the year. So it's increasing our investment. Compare with the balance carried down. So the balance carried down is 3875. 3875. So if you add 3375, which is the balance brought forward, plus what they received during the year, we are getting 4095. But at the end, we have 38. The investment is 3875. Why is it less? Why is it not 4095? Why is it 3875? Because the parent received what? Some dividends of 220. 220. He received a dividends of 200 what? 220. So net cash flow used in investing activities. Net cash flow. So up to this point, we have net cash flows used in investing what? in investing activities. In investing activity. So we take 4840 plus 1720 minus 8900 plus 5000 plus 220. So that is so 4840. So remember that the 4840, this one is cash paid. So this is an outflow. This is an outflow, cash paid. So this cash received, that is an addition. Cash paid, that is a subtraction. Cash net cash proceeds, that is an inflow. Dividend received is an inflow. So these are deduction. So minus 4840 plus 1720 minus 8900 plus 5000 plus 220. So this is 68. So this is an outflow. So that's why we say net cash flow used in investing activities. So this is B. And now finally C, we talk about financing activity. We talk about the financing activities. So an organization is financed by equity or what? Debt. So that is why we'll be looking at the equity and liabilities, what we have not used. So we combine for equity, ordinary share capital and share premium, you combine them. You combine them. You combine them. So for the ordinary share capital and share premium, you combine them. So the balance brought forward is if you combine the two, 8,000 plus 1,200, that is 9,200. Is there anything affecting shares under the additional information? We don't have any. We don't have any. So the balance carried. So the balance carried out. Balance at the end carried forward. That is, with this brought forward, carried forward. As at the end. As at the end, we have 10,000 plus 10,000 plus 1,500. That is 11,500. So there is an increase. So increase. So meaning that issue of shares. Cash received on issue of shares. Cash received on issue of shares. The amount increased because they received, the amount increased, this amount received here is because they issued shares. So cash received on issue of shares. If it's a reduction, you say cash paid on the redemption of shares. On the redemption of shares. So this is 2,300. So I can just mention proceeds, or just I say cash received, or I say proceeds from share issue. It's the same thing. Eh? The same thing. So that is a cash inflow. Eh? Then after that, after ordinary share capital and share premium, remember I will be focusing on the equity and liabilities, what we have not used. So we have started with ordinary share capital, share premium. What about revaluation? Would I use the revaluation here? Because if you look at the revaluation, as at the start is 3280. As at the end is the revaluation 4680. But remember there was a revaluation under additional information number 1, which affected our property, plant and equipment of 1,400. So if you add this 32, if you take 3280 plus 1,400, you are getting this. So there's nothing there. You are getting 46. you are getting 46.80. So there's nothing under evaluation. So the next thing to consider after evaluation, the next item is retained earnings. So these retained earnings, you are checking for dividends paid by the parent. Dividends paid by who? Parent. Dividends paid by who? Parent. That is what we are going to check for the dividends paid by parent. The dividends paid by parent. So the balance portfolio. So the balance portfolio there is retained earnings 32.80. So that is 32.80. Then you go to the profit for the year under the income statement. Profit for the year. And now profit for the year attributable to group owners. Remember that the parent is the group owner. Attributable to group owners. So profit for the year attributable to group owners, that is 46.90 from the profit statement of profit and loss. Statement of profit and loss. 46.90. That is 46.90. So up to that point, if you add the two, 32 plus 46.90. So this is 79.70. So balance carried forward from the statement of profit or loss, retained earnings, stated at 10. Stated at 10, it's 10.090. I'm sorry for that also. We have to change the batteries. So, was this retained earnings balance brought forward 32.80? I think I had picked a long value. It's 67. So, 67 what? The balance brought forward here is 67.80. All right, so that is okay. So 67.80 as at 30th September 2023, 67.80 plus 46.90. So that is 11.470. But the balance as at the end is 10. The balance as at the end is 10.090. Why is it reducing? Because there is dividends paid. Dividends paid. So 11.470 minus 10.090. So that is 13.8. Dividends paid. Dividends paid. Dividends paid by who? Group owners. That is the parent. So that is 13.8. 13.8. Then after that, remember we are done with ordinary share capital, share premium, revaluation surplus, retained earnings. So there is that equity attributable to owners of the equity attributable to group owners. That is the total. Then now we go to the non-controlling interest. So next we talk about non-controlling interest. We are almost done. We are almost done. I think this is the last working I will be doing for the non-controlling interest. So non-controlling interest. This is the last working I will be doing. So also here we are checking for the dividends paid, what they paid. Dividends paid. What these people paid, the minority shareholders, what they paid as dividends. So the balance brought forward is given. Balance brought forward. So the balance brought forward is 2,000. Balance brought forward is 2,000. Then if you check under additional information number 2, there was an acquisition of a Simba, which is a subsidiary. Its non-controlling interest was measured at its fair value at 21.25. So you add that. Acquisition of what? Acquisition of new subsidiary. Acquisition of new subsidiary. So 21.25. 21.25. Then there was disposal. Additional information number 3. You raise disposal. Is that disposal of subsidiary? Is this disposal of what? Disposal of subsidiary. So for the disposal of subsidiary, this one you need to carry out a small illustration, a small analysis, not an illustration, a small analysis. So they said the 20%, that is note 3. I'm reading under note, there's a paragraph under note 3. The non-controlling interest, the NCI, of 20% was measured at its fair value of 2,000 at acquisition. And the fair value of the Q4 Limited net assets were 4,600 as at that date. Goodwill had not suffered any impairment. As at the date of disposal, the net assets of Q4 were classified in the consolidated statement of financial position, and it was having 6,100. Yeah, but the net asset, this the aspect as at the time of acquisition and disposal. For acquisition, it's just acquisition. For Simba, it was just acquisition. But for this, remember, it was acquired sometimes back, then it was disposed during the current period under consideration. So when doing this disposal of subsidiary, we need to check 2,000. We check the 2,000 which is provided, which is the fair value of the non-controlling interest as at acquisition. Then we do what? We add the 20% of those net assets, the difference as at acquisition and as at disposal. So when it was disposed, it was having 6,100. When it was acquired, the net assets was stated at 4,600. So as at disposal. So you need to do this. So you have to do that. So 6,100 minus 4,600 times 20%, then plus 2,000, that is 2,300. So this one is disposal. You deduct. Then you add the share of profit from the statement of profit or loss. So the share of profit attributable to the non-controlling interest, which is 600. The share of profit attributable to the non-controlling interest, which is 600, from the statement of profit or loss. So 2,000 plus 21.25 minus 2,300 plus 600. So this is 24.25. So balance carried forward. Balance carried forward is for the non-controlling interest. The one provided is 1940, meaning that there is a reduction by 485. There's a reduction by 485. So that is dividends paid to what? Dividend paid to NCI. Those are some of the dividends paid to what? To those minority shareholders. So I come and say dividends paid to NCI. That is 485. Anything remaining under non-current liabilities, we have bank loan. We need to check if there is any bank loan which they paid or they acquired another one. Balance brought forward is 1875. Is there anything under the subsidiary which was acquired and disposed? Any loan? Any loan? There is no any loan down there. Is there any loan? We don't have any. So we compare 2,500 and 1,875. So it increased, meaning that proceeds from bank loan. They went for another loan. Proceeds from bank loan. Proceeds from bank loan. So the proceeds from bank loan. So 2,500 minus. So it increased from 1,875 to this 2,500. So 2,500 minus 1,875. So that is 6 what? 625. So that is money in. So up to this point, we can say that we have a net cash flow generated from financing activities. Net cash flow generated from financing activities. Generated from financing activities, which is 2,300 minus 1,380 minus 485 plus 625. So that is 10 what? 1060. So that is C. Then we can have a net cash flow here. Or we can call it, it's a net cash flow, or I can say net changes in cash. Net changes in cash. Net. That is a net changes in cash and the cash equivalents. Or you can just say net cash flow, or you can say net changes in cash and cash equivalent. $61.75. So now you get this addition: 1675 minus 6,800 plus 1060. That is 435. Now what we do? We need to add what? Remember, for cash flow, you can know you have scored 20 marks or you have scored some few marks. You can know that you are correct because the answer is in that statement of financial position. So after we have the net changes in cash and cash equivalent, that is now net changes in cash and cash equivalent. Remember that under the current assets, we have cash and cash equivalent as at the start and as at the end. So what we are trying to check is under cash flow, does this reconcile the cash we have at the start, then the operations during the year, does it reconcile with what we have at the end? So the cash and cash equivalent as at the start is 875. During the year, we have this. So if I take that balance brought forward, I add to these balances during the year. Am I getting the balance as at the end? So here you add what? Add opening cash and cash equivalent. Opening cash and cash equivalent. So the opening cash and cash equivalent I've said is what? 875. 875. So if you add 875, which is opening cash and cash equivalent, to net changes in cash and cash equivalent during the year, am I getting the closing? Am I getting the closing cash and cash equivalent? Am I getting the closing cash and cash equivalent, which is provided? Which is provided at 1310. Am I getting this 1310? Am I getting 1310? If you add 435 plus 875, yes, I'm getting this 1310. So we have done what? We have reconciled that. We have reconciled this one. So this question was tested in last sitting. That is question number 4. Advanced financial reporting and analysis. It was having how many marks? It was 20 marks. They were marking this way. Yes. They mark this way. They mark entries here. You see these entries? That is what they mark. these ones. They don't, and then they cannot mark this two. But they will mark this. So it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23. Out of 23 entries, when they were marking this, they needed only, out of 23, only 10 correct. They multiply by 2, you get your 20 marks. Guys, if you want to join my online classes, you can contact me through this number. I write this number here, 07, this is my number, 76546. So we do classes on Mondays and Tuesdays, and also occasionally on Sundays, 8 p.m. to 10 p.m. Charges is 5,500. You will be able to access videos and the live classes, which is done the way you have experienced it today. So this is how we do our online classes for this paper. Not only this one, even leadership and management. If you need also other papers, karibu sana. So I think it was a nice session. You have enjoyed. You have learned on how to consolidate cash flow statements. This is for AFR, Advanced Financial Reporting. That is for the KASNEB exams. But it also cuts across other exams, because there might be students here doing even SCCA, doing ICPAL for Rwanda, ICAN for Nigeria, and other exams. So what I can say, if you want to join my ongoing online classes, use this number. You can go and check some of the videos I've done under YouTube. My name is CPA Linochoy. I have done many sessions under YouTube. So, but now here is where we do, we cover the whole syllabus for the Advanced Financial Reporting. So we do topic per topic, questions. So I introduce our topic, we do questions. It's only that today I wanted to do direct question, but I do introduce our topic. So from our next session, I will be doing segmental reporting. So for that one, we have to introduce our topic. That is in terms of notes. We go through the notes before we go to the illustrations. We go to the notes, we go through the notes, we go through the format, then we do what? We do illustrations from the past paper. I don't use any other questions outside the KASNEB past papers. Maybe if there's another student who might be in need of a ICPAL, maybe another, I can use your illustrations, but mostly I use the illustrations for KASNEB. Thank you, have a good night. See you when I will be doing my session next time. And if you have an interest in joining, I've said that, use this number. So in case you get right, the 10 marks in the operating activities and fail to make correct entries in the other activity. Yet you get the 20. They doesn't consider where you have the 10. You can score the 10 here. Remember there was profit before tax. There was 1 mark there. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. If you could have scored up to this point correct, you have your 10 times 2. That is 20 marks. KASNEB doesn't limit that you have to do everything investing. No. When marking, they mark in a simpler way. For the guys who have joined my online classes, I think you have that aspect of how they mark. You have it. So, Brian. So we have come to the end of the session today. So see you next time.